Now let's get more on all of this with Ibrahim Suffian in Kuala Lumpur. He's the director of the Merdeka Center for Opinion Research. Thanks so much for speaking to us. So oil prices initially spiked on those renewed tensions, but quickly reversed course. What's the market telling us about how seriously it's viewing the prospects for a permanent deal?
Well, I think the market right now is contemplating, whether this is a permanent rebalancing or whether this is just a speculative relief. There is, I think, a collapse in terms of the premiums, insurance premiums attached to the current conflict. A significant of the recent price decline from the highs that were as high as $117 per barrel and now toward the mid-70s is partly driven by the rapid decline in terms of the risk premium, geopolitical risk premium that had been priced into every barrel due to the potential closure of the Straits of Hormuz. And I think markets are also reacting to the fact that the 60-day timeline right now represents probably a wait-and-see phase rather than a permanent resolution. There are still a lot of factors out there that can see closure or as a continuation of the conflict itself. So the markets are reacting towards the immediate cessation of hostilities, but the risk premium is still not fully eliminated, and instead is being replaced by some kind of cautiousness regarding the durability of the final deal. And also, I think there is a supply lag. As was mentioned earlier, it will take several weeks before supplies reach customers in East Asia. And so this will not be turned to normal very soon. Supply is constrained by obstacles as well as the time needed to restart idle fields.
Ibrahim, do you then think that oil prices will drop even further? And what price do you think that they could drop to if diplomacy continues on this route and continues to make some sort of progress?
Well, I think, it is possible for prices to drop further, particularly when we speak of the 80 million barrel buffer that has been spoken about. I think if there is sudden availability of stored Iranian crude, it comes out in the markets, this certainly will push prices lower. At the same time, there is also the dilemma for OPEC countries led by Saudi Arabia. In order to maintain prices above, say, the $70 per barrel mark, they will need to deepen their cuts in terms of outputs. And this is something that maybe countries like Saudi Arabia may be reluctant to bear because the burden of absorbing new supply is going to lead to a loss of market share. So there is this kind of strategic conflict that's happening, that OPEC Plus faces high-stakes scenario, whether they allow prices to dip to discourage non-OPEC production or increase their own output restraint in order to offset the Iranian barrels that will likely come into the market in the coming weeks.
How does that then feed into one of the big concerns now, which seems to be demand rather than supply? How much does China's weaker than expected oil consumption really change the outlook?
Yes, I think we are seeing that in China, demand has been lagging. It's reached new lows. And I think there are several factors feeding into this. Number one, in some parts of East Asia, there is structural dependency. East Asian refineries are heavily dependent or calibrated for the medium and sour heavy crudes from Middle East. And hubs like Japan will be very vulnerable. However, if we turn to China, the newer plants that they are putting in place, such as the Xinjiang petrochemical complex, they have the complexity to address the demand, or rather the supply of cheap Iranian crude. This can actually improve throughput, but at the same time, it could potentially lead to a temporary glut as refined products and ability for them to turn it around is going to meet with lesser than expected demand. So with the demand in China already soft, the influx of supply in the coming weeks will probably create a localized supply overhang and forcing refiners either to stockpile or aggressively push discounts in order to clear their inventory.
Ibrahim Suffian, really good to get your analysis. Thank you very much.